Hello and welcome to Charting the Markets with me, Victoria Scholar. All eyes today are on the Fed Chair Jerome Powell's keynote address at the Jackson Hole Symposium in Wyoming. Investors will be looking for clues as to the timing of the Fed's balance sheet wind down and, of course, potential gyrations in the US dollar. The greenback has been on the back foot this morning, slipping from a two-week high on anticipation of his speech. Elsewhere in the markets, US President Donald Trump told Fox News that the markets would crash if he were impeached, prompting questions about what an impeachment would actually mean for the equity bull run. Remember, as of Wednesday, we are now officially in the longest bull run in history. Whether that means markets continue to grind higher, of course, remains to be seen. Many analysts, though, predicting that there could be plenty more upside ahead. Now, to the week ahead, investors will be looking to see whether the US economy indeed is continuing to fire on all cylinders with the release of second quarter growth figures. Those are due on Wednesday. 4% is consensus expectations, revised down from 4.1% in the preliminary reading, which was the fastest pace in 4 years. Elsewhere in markets, oil looks set to close the week up by more than 3% after the worst losing streak since 2015. A decline in US inventories data this week and uncertainty around Iran have propelled WTI to the first possible weekly gain in 2 months. And in Asia, the big news comes from Australian politics. Treasurer Scott Morrison is set to become the new Prime Minister. He'll be no less than the 6th Prime Minister in under a decade. His win topped right-wing candidate Peter Dutton and Foreign Minister Julie Bishop. The ASX, the equity index and the Aussie dollar caught a bid on the back of the announcement. But that's enough for fundamentals for now. Let's move on to the technicals. I'm pleased to say that I'm joined by a guest this morning who's an expert on technical analysis to talk us through some of the charts he's been looking at. Serge Berger joins us down the line from Zurich. Serge is from thesteadytrader.com. Serge, thanks so much for being with us this morning. Let's start with the IBB, that's the biotechnology index. Why does this chart look interesting to you, Serge?
Good morning, Victoria. Yeah, so, the IBB is really just a sub-segment or an industry group of a broader sector, which of course is healthcare, and healthcare stocks have really had quite the move over the past few months as money was rotating into this part of the market here, as you can see. But more specifically now, if you dig a little bit deeper, while some of those stocks were getting overbought, some of the larger pharmaceutical companies, something like biotechnology stocks here are continuing to kind of coil up. If I draw some very simple technical lines here, you can see we've got a really nice consolidation period here. And again, unlike some of the other parts of the healthcare, at this part of the market, it has consolidated and does look ready to go, even if you look a little bit deeper into the constituents, some of the large cap biotech names out there.
It's interesting to think about whether you see this as a defensive play or an offensive play, because there's that technology element, of course, but then there's the healthcare pharma element. How do you see that?
Yeah, well, I think that's the surprising thing. So you have, when money rotates around in the U.S. markets, the U.S. markets are a little bit differently than, say, European equity markets. A lot of it, stocks are a very highly correlated asset class. So institutionals don't go out and just buy one stock most of the time in any given group or sector. They kind of buy a whole basket. So when they start buying healthcare stocks, it's not just Pfizer or Merck. They end up buying a whole basket of it, and I think that's why this could see more upside as well. And of course, continues to be a growth story in this part of the market as well.
Right, so yes, it's a nice way to kind of diversify if you want to there. Now, another stock I know you've been looking at closely is Apple. Of course, it won that race to $1 trillion. The question is, can that upward trajectory continue, or is it time to take profits?
Yeah, I mean, I think, obviously Apple, huge market cap stock, an important stock to watch for many reasons, because aside from the technicals for a second, if you look at it through the lens of how are people allocated, obviously Apple a huge part of the NASDAQ 100. And so, if that stock, if it were to crack at some point, and that's not my forecast here, it would also cause a lot of other stocks that are quite dependent on it to come down. But I think at this point, really, my main sort of observation is I wouldn't be buying the stock right now. It's certainly not from a trading perspective. Very simple lines you can draw. A lot of times, with just by keeping it simple, you gain a lot of perspective. So this is your long-term weekly chart. We can kind of draw a parallel down here. You can kind of see that's been the upward move. And the more we zoom into this chart, the more you can see the more vertical we've gotten. If I were to move a very simple, something like a moving average convergence divergence index or oscillator at the bottom, you can see we're basically in uncharted territory in terms of how far this stock is removed above some of its intermediate and longer-term moving averages. So my call here is not to be buying the stock. I think from a long-term investment perspective, there should be better entry points, maybe closer to 200 or lower. And from a trading perspective, it's still dicey as well.
So you're saying don't buy it here, but I assume that's a choice of language there, because you're not saying sell, are you?
No, I'm not saying short. I do think there's a profit-taking opportunity depending on your strategy and your time frame, which for a lot of people that probably would be a yes on taking profits, or at least partial profits. But it's not a short in my opinion. It's just I wouldn't be buying it here at this point. And
what about the tech sector more broadly? Is that still a buy, do you think?
I think the tech sector, what it's seeing is there's actually a lot of divergence in within parts of the market. So like one big part of the tech sector is, for example, semiconductor stocks. The SMH ETF is one that you want to look at here. And we had, of course, earnings last week from a company called NVIDIA. That stock initially gapped down. Now it's moving higher. So I think there's a lot of tug of war here. We've become much more defensively postured on large cap tech, not to be short, but much more, I guess, neutral to defensive in the sense that we don't want to buy them right now as a group.
And I guess that ties in with a lot of market participants who potentially think that we could be coming towards the end of the bull run. So perhaps it's time to step away from the tech sector, at least making up the majority of the portfolio. Now, I also wanted to ask you about the Russell 2000. That, of course, hit another record high this week, making the history with the longest bull run ever. Those small caps clearly benefiting from those US tax cuts. What are the technicals suggesting on that chart?
Yeah, Russell 2000 is interesting because the Russell 2000, if you look at it in terms of sales, I think the sales are about 23% of sales of the Russell 2000 companies, which are mostly U.S. domestic companies. I think only about 23% of sales are overseas. You juxtapose that to the S&P 500, and the S&P companies have, I think, about almost 50% of sales, or maybe even a bit more, overseas. So that, of course, brings us back to something you mentioned in the introduction, which is the dollar. The dollar has had a significant rally. I think we could continue to see at least somewhat of a bid, and ultimately that's not going to be great news for the S&P. But guess what, for the Russell 2000, at least in relative terms, that's not so bad. Technically speaking, now you can see the Russell 2000, very nice consolidation phase. I'm just going to draw some very simple lines, usually helps just to give us some simple visuals. And you can see we ended up breaking out of this phase, and we're now basically breaking out of this phase as well. Again, I'm not expecting this to be a straight shot higher without any pause, but at the moment, I prefer this over the S&P 500, largely because what's happening in the dollar.
And you mentioned the dollar there, so let's get your take on the technicals there, because it has been moving higher and higher, but there was a bit of a pullback earlier in the week on the back of those comments from US President Donald Trump about Fed Chair Jerome Powell criticizing his stance towards monetary policy. So do you think, I mean, you said that there's further upside for the dollar, but it seems like a very, very crowded trade. When we look at the CFTC data, the market is hugely long. So, I mean, is there any chance of possibly going anti-consensus here?
No, I think there's a lot to be said about that. To me, right now, two of the riskiest trades are the dollar and rates, because the question is, of course, is the Fed going to stay its course and remain independent, which is their mandate. I do believe they will, certainly now with some of the news that's come out, and yesterday that was kind of reiterated by some of the people at the Fed. But I do think the dollar continues to see an upside, because it also has to do with cyclicality. If you look at it historically speaking, the dollar tends to do quite well once the globally synchronized recovery kind of decouples, and we've seen that take place most of the year. And so I still think the dollar has more upside. I don't think it's a raging buy, but I wouldn't be short the dollar right now, really purely based on those kind of really facts.
Now, switching focus, let's move to Asia, because I know there's a chart that you've been looking at closely, and that is Alibaba. They had profit which fell short of analysts' expectations, and that sent the shares down by more than 3% overnight. What's the chart looking like to you?
Yeah, so Alibaba's interesting, and this kind of goes to my point from earlier about the correlation within equity markets, and even here within Asian equity markets. And if you look at this chart here, the candlestick chart, the colorful one, is the chart of Alibaba itself, so BABA stock. The blue line is the China large cap ETF, so it's large cap stocks. If you look at this just through a very simple technical lens, you can see the correlation is quite uncanny. Now, it's not perfect, but there is a pretty strong correlation. If you look at Alibaba itself, it is now coming into a major area of confluence resistance between its 50, 100, and 200-day moving average, which it rejected with a vengeance yesterday. That's this candle right here. I don't know if you can see that very well, but I think the correlation here between this and the broader Chinese stock market, which, by the way, the Chinese economy has been slowing and continues to slow in 2018, is quite good. So I think Alibaba here, bearing any major outside news, is probably not going to have a lot of upside, and I would think probably a little bit more downside than upside at this point.
All right, so potential downside there for Alibaba. Serge, thanks so much for your time.
Thank you, Victoria.
That was Serge Berger from thesteadytrader.com. Thanks so much for watching Charting the Markets. I'm Victoria Scholar. And remember to find me on Twitter for more updates. I'm at VictoriaS_IG. Have a great weekend.